Alright, that's Prashant Jain. Let's now move from HDFC Mutual Fund to Sundaram Mutual Fund. All the fund managers for the first time are on the same page, which is they're saying that there is value in mid and small cap stocks and it's time to really pat on the front foot right now. Sunil, the broader messaging is that the risk reward ratio is in favor of investing.
Correct.
Why are you saying that? Because when you say risk reward ratio is in your favor, you need to take account of growth, earnings, global cues, and also valuations.
Correct. So if you then look at it from a perspective of relative valuation, see what has happened is that mid and small caps have corrected far more than large caps, giving an impression to the investing public that there's something deeply wrong. People are reading the auto slowdown, NBFC crisis into a performance crisis for mid and small cap. That's far from the reality. If you take last year's earnings, and just I'll stick to mid cap and small caps, mid caps and large caps, and I'm not going to use the index at all. I'm going to use the actual large cap stocks that SEBI defines and actual mid cap stocks that SEBI defines, which is top 100, next 150. Let's leave small caps alone. Believe it or not, April 2018-19, large caps grew 14.5% in their PAT growth, mid caps grew 49% in their PAT growth. Okay, now there's this thing that, no, banks are the ones who are causing that. Yeah. So let's take away banks from the large caps. Large cap earnings are down 7%.
Okay.
Down, growth on 7%. Mid caps are 20%.
Where in the mid cap basket are these numbers coming from? In the sense the kinds of names or the sectors?
So actually speaking, it's broad, right? Except for auto and the NBFC sector, it's broad. Across the thing, the earnings growth is good. And let's come to this quarter. Sure. Now, I mean, I'm still talking. We're talking about this quarter, slowdown, everything, right? Even this quarter, mid-cap companies, our analysis shows that mid-cap companies have delivered better value than large-cap companies in PAT growth.
So there would be a point at which markets would say that, look, we can't shut our eyes to the fact that FIs are selling 1,000 to 1,500 crores on a daily basis. Indian market or Indian economy is a capital-starved economy. While DIs are great news that 8,000 crores, so what DIs are getting on a monthly basis, FIs are selling on a weekly basis.
Correct.
Where do you think this tug of war is headed? And if FIs continue to sell, will that act like a sledgehammer, more like a backbreaker for large cap stocks also now?
No, I'll tell you where. I think the right way to look at this is, see, everybody expected this Nirmala effect to come and bounce back, right? They associated the drop in FPI flows to the taxation, which could have been a trigger, and they expected when that was released, the flows to bounce back. And markets were disappointed that's not happened. But you take a look, quarter to date, all emerging markets are negative. So I would hesitate to call this FPI continuing outflow as an India-specific factor. It is reflective of a move away from risk equities into gold and safe haven fixed income assets in the US, which is preventing the money from coming to emerging markets. So there's a risk of, because of the world economic outlook. Now, it's not India-specific, number one. Second, when equities comes back in favor as an asset class there, India will be the first market to get that bounce back. So I don't share this view that this FPI outflow is going to continue. I see a reversal happening as early as the next quarter, the OND quarter. The reason for that is that that's the quarter, two things happen. One is the market discounts FY21. Right?
Sure.
And you have greater clarity when you buy India. And added to this is the India uncertainty factor. Nobody expected this India slowdown to be so sharp, even foreigners, right? So there has been a little bit of caution there. The second thing which is happening, Nikunj, to answer your question, is because FPIs are selling, most of the mutual fund buying is going into large caps today.
Okay.
Because they're able to get those cheap where they are buying. So
why will mid caps go higher? If you guys are buying large caps.
Correct.
So I'll buy mid caps.
Correct. So I'm saying, so what is taking it up is that as the continuing differentiation between mid cap earnings and large cap earnings continues, the large cap PE ratios are going to shoot up. So already we are at a 20% plus discount on forward PE on mid cap versus Sensex.
And this used to be 50% premium 2 years ago.
35% premium December 17.
Yeah.
So we are at a 55% valuation drop.
So mid caps are here and valuations are here.
So 16.5 is the Nifty forward PE, 12.9 is the mid cap forward PE. So you're at a 20% plus discount. So historically, the worst discount in the recent past has been 30%. So what I'm trying to say is that when does the market re-rate the PE, right? When the actual earnings come ahead of the expected earnings, right? So already that's beginning to happen. The clarity in terms of what exactly to buy will come in. And to me, what we should all focus on, see, we are focusing on the government coming and bailing out the auto sector, bailing out the NBFC sector. All of that as government can do as a trigger, as an input, right? And the output and the outcome is not in their control. But there's one thing where the input, output and outcome are all in their control, there's government spending. So government spending on capex will directly translate into cap code orders for small and mid-cap companies and sectors like cement, building materials, all of it. So I say those will lead the rally in October, November, December, and you will see a very sharp bounce back, according to me, that when the large caps come to a stage where the valuations versus the P ratio and the comparative valuations, next quarter itself, I see that fund managers will now start accumulating, because today, unlike the situation in December, see, one of the things to understand this fall is to understand the rise. Okay, and if you give me 2 minutes, I'll explain this. 2016-17, right, December 2015 was a low point on valuations and the index in the recent
December
past.
2015.
Okay, right. 2016 and 17 is when the rally happened in the index.
Demonetization.
Right,
Money
it was
came into markets,
demonetization. So the 2 years, I just did the number crunching. 47,000 crores in 2016, 1,20,000 crores in 2017. The mutual fund industry suddenly got a bonanza of 1,65,000 crore. At the same time, FIS brought in 75,000 crore because the world was also going through. So 2,40,000 crores suddenly came to the market. And what happened was, since Nifty earnings were not going anywhere in those 2 years, every quarter you saw it was single digit, right? The FIS had no choice but to buy those single digit earnings because relative to the rest of the world is still looking good. So domestic fund managers panicked, and what was largely a large cap flow got diverted into a mid and small cap flow. It was irrational in that sense, but it happened, and that's where the valuation went up. What happened in December 2017? Two things happened. World economy started reviving. In the year 2018, there was a reverse flow from emerging markets out into, right? So immediately fresh money went into large caps because FIs started selling. Right, when FIs were selling, the mutual fund was shifted. One. Second, the hammer came from SEBI in terms of the mutual fund rationalization of schemes. So now a fund manager had to clearly say that this is my large cap scheme, and you had only one large cap scheme in your whole set of funds. What happened was immediately they had to sell out all the mid and small cap stocks they had accumulated over the last 2 years in the space of the next year. That's why, despite that earnings gap differential, there was heavy selling on mid and small caps, right? Today's situation is very different. Because of the scheme rationalization, only 26% of the industry's equity assets are in pure large cap funds. 74% are in diversified, small cap, multi-cap, balanced, whatever, wherever. So the fund managers have the ability to buy mid and small cap if they choose to buy. But today, because FIs are selling, the large caps are looking the safety, and since that safety factor is dominating both their FIs and India, they are still buying large caps. So that's why whatever we buy. So, but just in a quarter, I see this to turn around because that differentiation is continuing to happen. Even if you take this quarter's earnings, give me a minute, I have the data with me. I'll just tell you that data. Okay, this quarter's earnings, large cap, top 100, PAT growth was 8.9%. Take away the banks, it's negative 7.2%. Top 100 stocks, this is not only Nifty.
Okay, so my follow-up question is that when the economy will recover, I think those numbers
just 1 minute, let me just finish this. In the mid-cap space, the earnings was negative 1.4. Take away the banks, is positive 5.4. So ex banks, you're looking at large caps minus 7.2, mid caps plus 5.4. Give me a break. So it's a matter of time. This is the actual earnings of every single company in the.
We have 3-4 minutes before we take a break, so we can extend the conversation. But my next follow-up question really is, when the economy will recover, operating leverage will kick in for large cap companies, right? Whether it's steel or cement. So why should one not buy large cap stocks? Because if the play is that tomorrow will be better than today, then the operating leverage would benefit the companies which are sitting on capacities and which will gain because of interest rates and because of demand revival.
No, actually it's the reverse.
Okay.
The operating leverage of mid and small cap is far higher because A, they pay much more higher interest in the downturn, one. Second, the proportion of their fixed costs is much higher.
Individually if I analyze.
No, even as a segment, right? I would say something like for a large cap cyclical company, I would say 55 to 60% is his fixed costs, which is the operating leverage. For the same thing for a mid cap is 75 to 80%. So though the operating leverage they are in a big place, the fact is the relative growth for each one, YOY, you will see that kick in. So I believe that the bounce back on the mid and small cap will be far sharper than in the large cap. Though in absolute quantum what you say is right, one. Second is people are still buying large caps, right? My point is that since they are ignoring mid caps, so that's when you will see the valuations are already predicting what you are saying, Nicole.
Right.
Sunil, now tell us about your favorite quote, which is from Benjamin Graham.
Yes.
On the screens. Investor is a realist who sells to optimists and buys from the pessimists.
Exactly what I have been talking about the last 15 minutes, right?
We could have just read the quote out.
Yes, exactly. Right? People are pessimistic about the medicine market. You got to buy from those pessimists today, and the optimists who are buying IT, like because it's a safety sector, right?
What makes you so confident of the earnings recovery though, Sunil?
No, I'm just talking about the actual earnings, right? And let me look at it this way, right? At all points of time, you see 1 year, metals and auto have corrected 35%. So isn't that the market telling you that already corrected the earnings forecast? So when you say earnings recovery, what I'm saying is you got to focus on reality versus predictions. Market is constantly focused on that. So as long as the expectations are beaten by the reality, it doesn't matter whether it was 3 versus 5 or 18 versus 20. Market is always trading on that expectation, and as long as the expectations are beaten by the reality, the re-rating will happen. It doesn't mean that you need to go back to that 18-20% earning growth for you to see that 18-20% stock price growth.
Sure.
Okay.
Great having you in the studios.
Right.
Thank you,
Thank
Sunil.
you.
Thanks so much for taking the time out. Quick take at what the market then is up to and where we've settled down. I can't say it's a very strong follow-through from where we left it off yesterday, but we've dragged ourselves all the way back to the 10,900 mark. The breath, although it started off on a rather strong note, has also sort of caved in from there. So we're about almost running neck to neck relatively. It's NTPC, it's Coal India, IOC, ONGC, NARCO, largely the PSU chunk which is holding out. On the flip side, financials are the ones which are seeing that price adjustment. So be it HDFC, be it Bank of India, LIC Housing Finance, IDBI, these are your pressure points in trade. But let's chat with Arul Selvan, who is the DEVP and CFO at Cholamandalam Investment, joining in the show right now.